34.7% of active U.S. home listings have taken a price cut. Per HousingWire, April 17, 2026. 1 in 3 homes on the market, sitting at a price the seller already tried and the buyer already ignored. 8.9% have been relisted entirely. Average days on market, 118. Median, 56. National median list price, $445,000. Inventory up 8.1% year over year through March 31st, per Resale Club. Supply is rising faster than seller expectations are adjusting. That is the entire story in one gap. The spring market is adding inventory, as it always does, but pricing has not moved with it. Sellers anchored to peak era expectations. Buyers pricing to today's data. That mismatch is the most important signal in the current market. 78% of U.S. home purchases closed below asking price in February 2026, up 3 points from a year earlier. Per Cotality, March 2026. In Florida, that figure was above 90%. Buyers are out there. They are refusing to overpay. Weekly pending sales, 73,241 mid-April, up from 71,775 a year ago. Demand is not gone. The buyer has leverage for the first time since 2020 and is using it. That is a structural shift, not a seasonal blip. 21 days in 2021. Buyers waiving inspections, paying above asking in cash. 65 days pre-pandemic normal. 118 days today. The direction of that bar chart is not ambiguous. If you want to see the real numbers behind the headlines, subscribe to the Data Desk and hit the bell so you never miss a breakdown. The national number is an average, and averages hide what is actually happening. Because this is not one housing market. It is 2 completely different markets running in opposite directions in the same country at the same time. Miami, months of supply approaching a full year. Austin, Tampa, and Houston near 8 months. 43 of the 53 largest U.S. cities carrying over 7 months of supply per AEI and Fortune, April 2026. That is the bottom tier of a buyer's market. Kansas City, plus 8.6% through February 2026. Pittsburgh, plus 5.8%. Milwaukee, plus 5.6%. Chicago and Philadelphia, plus 4%. Per AEI, April 2026. Same country, same month, opposite direction. The Sun Belt is correcting. The Rust Belt is rising. Mortgage rates sit at 6.29%, and the median resale home now costs more than a brand new build, a reversal that has happened only 2 or 3 times in recorded history. Why the Sun Belt collapsed while the Midwest held. What JP Morgan and AEI project for prices by year end, and what the data says about where the real opportunity is right now. Part 2. The Sun Belt boom required 3 things to hold: mortgage rates near 3%, continuous migration, and no new supply. All 3 reversed simultaneously in 2022. The correction was not a surprise. It was arithmetic. Austin, plus 100% from Q4 2019 to Q2 2022. Miami, plus 50%. Phoenix, plus 60%. Dallas, plus 64% per AEI data. Those gains were real. The conditions that produced them are gone. 0.6 months of supply at the pandemic peak. Effectively, nothing to buy. 4.6 months by September 2025. Still climbing at 8.1% year-on-year through March 2026. This line has moved in one direction for 3 consecutive years. Builders kept building after migration slowed and rates spiked. New construction now accounts for 26% of total housing inventory, up from 12% pre-pandemic per NAR. Builders cutting prices and offering rate buydowns to move product pulls buyers away from resale homes, adding to resale inventory, a feedback loop. Florida has 7 of the country's 10 steepest price declines. Cape Coral, minus 9.6% year-to-year. Northport, minus 6%, now 8% below its peak. Per Cotality, March 2026. The state that led the pandemic migration wave is leading the correction. Dallas, Raleigh, Austin, Denver, Nashville, active listings up more than 350% since January 2022, per NAR 2026. Austin approaching 8 months of supply. Texas, 78% of homes sold below asking, per Cotality. Kansas City, plus 8.6%. Cape Coral, negative 9.6%. 18.2 percentage points between the top and bottom performer. Same country, same month. The outer ring is where supply stayed tight. The inner ring is where builders kept going. 11 states are now above pre-pandemic 2019 inventory. Arizona, Colorado, Florida, Idaho, Nebraska, Oklahoma, Oregon, Tennessee, Texas, Utah, and Washington, per Resi Club, March 2026. Every one of them a pandemic boomtown. Arizona and Colorado also above pre-pandemic inventory. More supply than post-migration demand can absorb. Sellers competing with each other and with builders at the same time. Connecticut, 65% fewer homes than pre-pandemic. Rochester, 49% of homes sold above asking in 2025. Per NAR, 2026. The Northeast did not overbuild. Prices are still rising. Buyers are still competing. 2 housing markets, same country. The next question is the rate, because at 6.29%, mortgage costs are keeping millions of qualified buyers on the sidelines in both markets simultaneously. And 3 major forecasters just released their year-end price projections. Those numbers are in part 3. The rate is the variable touching every part of this market at once. At 6.29%, a 1-point drop opens home ownership to 5.5 million additional households, including 1.6 million renters who could qualify as first-time buyers per NAR. About 10% of those typically act. That is 500,000 additional sales waiting on a rate move. 2020, 2.6%, the floor that ignited the boom. Late 2022, 7.0%, the spike that stopped it. April 2026, 6.29%. The buyer demand threshold HousingWire identified is 6.25%. The current rate sits 4 basis points above it. 4 basis points. That gap is why pending sales are holding. 73,241 week of mid-April, up from 71,775 a year ago, but not accelerating. The buyer is present. The math is not quite there. 5.5 million households unlocked by a 1-point rate drop. 1.6 million of them renters who could buy for the first time. Per NAR, 2026. That demand pool is on the sideline right now. 6.29% is keeping it there. Buyers are showing up to open houses and making offers below asking. 78% of purchases closed below asking in February, per Cotality. They are not refusing to buy. The rate is why they are not closing at scale. Now the forecasts. 4 institutions, same question, different numbers, all in a 2-point range. JP Morgan, 0% national price growth in 2026. Zillow, April forecast, plus 0.3%. Redfin, plus 1%. AEI projects negative 1% by December 2026, then negative 2% in both 2027 and 2028, per AEI Housing Center, April 2026. Not a crash call, a stagnation call. Prices going nowhere in nominal terms while inflation erodes their real value. For a pre-pandemic buyer with equity, manageable. For someone who bought at peak 2022 with limited down, a different math. AEI, negative 1%. JP Morgan, 0%. Zillow, plus 0.3%. Redfin, plus 1%. 4 forecasters, a 2-point spread, all pointing to the same conclusion. National home prices are going nowhere meaningful in 2026. The national average conceals the regional split. Northeast and Midwest projected at 3 to 4% growth. Sunbelt, flat or declining. Same national number, 2 completely different markets. Indianapolis, Kansas City, Oklahoma City. Tight inventory, strong rental demand, did not overbuild. Per NAR and JP Morgan, 2026. These markets are not in the same correction cycle as Miami or Austin. They are in a different story entirely. 1.05 million new single-family starts projected for 2026 by NAHB, up 4% from 2025. Builders cutting prices and paying rate buydowns pulls buyers from resale. The supply does not stop in the Sun Belt, and neither does the pressure on resale values. The resale median home price now exceeds the new build median, only the second or third time in decades per NAR. That single inversion explains where buyers are going and why sellers are not ready for it. Part 4 closes the data file. The resale median is $408,800. The new build median is lower, per NAR, March 2026. That inversion has happened only 2 or 3 times in modern housing history. Builders in Sunbelt markets are cutting prices and paying rate buydowns to move product. A new home in Austin or Tampa now costs less monthly than the equivalent resale. Buyers made the rational choice. Resale sellers did not see the competitor. $408,800, the median existing home. Above the median price of a brand new home for the first time in decades. Per NAR, March 2026. Builders changed the math. Resale sellers have not caught up yet. The structural floor still holds. National active inventory remains 13.6% below pre-pandemic 2019 levels per Resi Club, March 2026. The housing deficit has not disappeared. That is why this is stagnation, not collapse. 26% of total housing inventory is now new construction, up from 12% pre-pandemic per NAR. Builder incentives undercut resale on monthly payment in Sun Belt markets. That is a structural pricing problem for existing home sellers. 34.7% of listings have cut. 8.9% have relisted. Sellers priced correctly from day one are transacting. Sellers anchored to 2022 peak memory are at 118 average days and counting. The rental market runs the same pattern. Single-family rent growth, 1.2% year-over-year nationally in December 2025, down from 2.5% the prior year. 18 of the 50 largest metros posted outright rent declines, 8 in Florida, 3 in Texas, per Multi-Housing News. The same overbuilding hitting purchase prices is compressing rents in the same zip codes. Since 2020, rents are still up 32%, about $600 per month per totality. The annual rate is decelerating. The cumulative hit is not. 18 metros with rent declines, 8 in Florida, 3 in Texas, per Multi-Housing News 2025. The overbuilding story runs through purchase prices and rents simultaneously in the same markets. 34.7% of listings with price cuts. 118 average days on market. Inventory up 8.1% year over year. Rate at 6.29%. 4 basis points above the threshold that historically unlocks a demand surge. That is the market in April 2026. The market is not broken. It is repricing at dramatically different speeds depending on where you live. The national headline misses that entirely. The data does not. The buyer who reads this data has time, inventory, and leverage the 2021 buyer never had. The seller who prices to the current market is transacting. The rest are contributing to the 34.7%. What stories should we break down next? Drop it in the comments, and we will see you in the next data file.